Morning. My name is James Mullen. I'm the head of capital markets for Manulife's real estate credit team. Welcome to Unlocking Value in today's core markets where capital meets strategy. Today we're going to explore how interest rates, narrow credit boxes, and shifting demand generators are forcing investors and lenders alike to rethink the playbook. Before jumping in, I'll let the panelists introduce themselves.
Hello, everyone. My name is Maggie Dykman. I am a managing director, head of East Coast acquisitions at CityView. CityView was founded in 2003, headquartered in Los Angeles, and we are a vertically integrated multifamily specialist. We focus across value add and development, and currently have 3,000 units either under entitlement or development, and 8,000 units under management. My job is to expand our operations on the East Coast, and we are looking for developable land and value-add opportunities.
Hello, everybody. I'm Francis Greenburger, CEO and chairman of Time Equities, Inc. We're a highly diversified real estate investment company, private. We own, I think, 43 million square feet of space, 37 states, and 7 countries. So we're international as well as domestic. And we do a range of transactions from stabilized to highly opportunistic, and we also do development. So we do all property types except hotels.
Great. Let's jump in. Given today's capital and rate environment, how are each of you deciding which assets to fund or pass on, and how have the deal structures changed over the last couple of years?
Sure. I think it's actually changed a lot just in the last 6 months. For the past couple of years, we have really been looking for value-add opportunities that were priced below replacement cost. That has changed dramatically as a lot more groups have entered the space. The financial markets have come back, and so we're seeing a convergence of pricing between core plus and value add. So what does that mean for us? We are looking more and more at development opportunities. The last 2 deals that we have done were ground up 200, 300 unit wrap projects in the San Diego area. So we're busy doing that and looking at developable land and entitlement opportunities.
So since we do this, we're all about diversification. It's also true in our acquisition strategies that we do stabilized as well as opportunistic. But the basic theory is a simple one. We want to be buying positive leverage, and not only relative to the current interest rate environment, whatever we perceive as the long-term stabilized rate, which I'll say for, in general, that usually means between 5 and 6%. And that's a kind of steady mantra for us. So when interest rates are 3, we don't buy cap rates of 4 or 5. We stay out of the market. But, generally, we're looking to buy a fully underwritten 8, so we have positive leverage, even if rates are 6. And, of course, more recently, rates have been between 6 and 7. Now they're sort of back towards 5s, or in the 5-ish range. So even though the highly structured capital stack is showing variations in funding costs and rates, we source all our equity from privately. So we don't really, and generally, with rare exceptions, we don't use mezz, institutional mezz, or institutional pref. So we're less sensitive to that. For us, it's more a matter of can we buy properties that sort of meet our criteria, and depending on where each particular market is, are they cap rate compressed or are they more long-term cap rates that we can live with? That's what guides us. And on the opportunistic side, you know, we're similarly driven. Obviously, as an example, when we buy office today, you know, yes, we expect highly accretive cap rates, but we are actively buying office, even though the narrative is against it.
Great, thanks so much. I guess digging a little bit deeper into the structures, I think from a lending standpoint, we've seen a pretty big ability for us to, whether that's require leasing hurdles or construction milestones or certain reserves. Have you guys noticed that popping up more now recently, and how are you guys handling that component of the structure? Francis, if you want to start.
All right. The way we're handling it is pushing back. I think a lot of very skilled and smart lawyers on both sides, together with their bank clients, stay up nights thinking of new ways to create various structures and caps and tests, and would like us to take one every day. Well, it's hard to operate real estate around so many constraints, and particularly when those constraints don't formally recognize the cyclical nature of property. So one of the favorites today, which I knew because it started in Europe years ago, is this idea of interim DSCR tests. And if you fail the test, you have to resize the loan. How does that make any sense? So I have some tenant who moves out. I'm carrying the property. I'm paying the interest. Every loan's current. And it's going to take me a year or two to lease up the building again, at a minimum. But the lender would like me to pay up my $50 million mortgage down to 30 because it's the DSCR is out of whack for a recovery period. Well, to me, agreeing to such a thing is a suicide mission, and I wouldn't recommend it to anybody. And if your lender asks for them, those things are just unrealistic and don't reflect the true nature of property operations. You know, they might as well ask you to stand on your head at midnight.
Maggie, you want to add anything?
Got my opinion?
Wow, received. You know, multifamily, at least my type of multifamily, is a little less binary than a tenant moving out and you fail a DSCR test. That said, for our operating properties, rents have been slower to trend than we would have liked, and we do have some of those tests that we have to deal with. I would say, depending on the lender, you usually don't have to do the full amount. There is always some type of negotiated middle room, and I think the space is getting more competitive, especially the type of proceeds that we're looking for, which is a little higher octane, probably 80% LTV. We're seeing it getting spreads coming in, tests getting a little looser. So it was tougher a couple years ago, but we're making progress on it now.
Yeah, I think that both fair descriptions of how we're handling anything where there are triggers come up or something happens. It's really trying to work with folks instead of trying to play a little bit of a gotcha game. Maybe shifting gears slightly, where are you both deploying capital currently today, and maybe expand on markets, demand drivers, geographies, and things that make those opportunities attractive? I don't know, Maggie, if you want to take this one to start.
Sure. So we're definitely actively playing in our home market of Los Angeles in Southern California. Again, doing a lot of entitlement projects and really gearing up for capital to come back to the development side of the business. We're actually even working with a programmatic partner to buy up land and start fronting some of these development costs because we have strong conviction that there will be a new development wave. Here on the East Coast, it's a little bit different as we are not yet vertically integrated. So we're looking at investments with the story. So one of the opportunities we're working on right now is a middle market aggregation strategy in Boston. We did something similar in LA where we created a hub and spoke model of property management, and it worked really well for us. So that's what we're working on now.
So I made some notes to make sure I didn't give you false information. We closed 17 properties in the last 12 months. They're located, well, I don't remember how many states, but also 2 countries. We closed on 5 industrial properties, 2 multifamilies, 1 student housing, 5 retail properties, and 4 office properties. The office properties, well, consist of what I think are sort of one of the best opportunistic buys in the market, because obviously there's a strong narrative against it, and we're buying properties at 20 to 30% of replacement cost, often with going-in yields of 12% on 50 to 70% occupancy. So you got a lot of upside, but you're starting at a 12% cap rate. That's pretty good, and that's not leveraged. That's on project cost, unlevered. And the others are mostly stabilized, but again, in the positive leverage version that I mentioned. I think the 17 properties are in 14 different states, so highly diversified from Alaska to Brooklyn.
Great, thanks. I think maybe diving a little bit more into those properties, when you guys look, are there certain, whether it's certain supply-demand economics, rent growth, maybe Maggie on the multifamily side, and Francis on some of the office assets that you're looking at, are there certain things that you guys look for as common themes across those properties and those deals that you're looking for?
Yeah, I mean, it's really 2 things for us. First is just general growth, high growth markets where you're seeing a lot of inflow in population, but then also resiliency. We've run a market study looking at a whole variety of metrics, and just seeing how quickly markets bounce back is a big factor when we're deciding if we're going to lean into a certain market.
Well, real estate markets are dynamic, and they probably changed in the last 60 seconds. Right now, trends we see in some of the different food groups. Industrial, because the rents have been moving up so strongly in the last few years, often we find that that the current rents are below mark-to-market levels. So there's usually a gap between when you mark the rents to market and the older leases. There's usually upside. So industrial properties often have that characteristic, which of course we like, particularly if we can go in at a stabilized yield of 8% or thereabouts. Multifamily, as we know, the markets have they're uneven right now. There are a number of markets that are facing overbuilding, and so you see rents declining, occupancies declining. So those are not good places to be. On the other hand, probably at least half the markets or more, I think, are stable. And some places, I mean, I was just talking about, we completed a very large building in Chicago, 740 units, 74 stories within the last 18 months. That was a ground-up building that we did. And Chicago rents, the market is as hot as it could be, particularly for high luxury, highly amenitized product, which is what our building is. And interestingly, before that, for the last 3 years, talked to most lenders about Chicago. They said, not our flavor. So getting that building financed was very hard, but that's usually a good sign because it means that it won't have a ton of supply coming on you, and if you can get through it, it'll come out in a good way. Student housing, obviously we don't have a lot of student housing, but we have a portfolio of them, and there were challenges to enrollment that one has to be really careful about. And the current immigration policies are very negative for student housing because we have a lot of international students who are leaving or not coming back. So you have to be careful. We only buy state colleges because we feel that it offers the best value proposition. Retail, this is good times in the retail business. And I would say almost every lease renewal we have is at an increase, and our occupancies are at an all-time high. And, you get an empty store, somebody's usually waiting to move in. Office is a much more complicated subject. There's obviously a lot of vacancy throughout the country. On the other hand, if you talk to many attorneys who do leasing transactions, they'll tell you they're very busy doing office leasing, and that's our experience throughout the country. It's a little bit of a feast and famine business in the sense that you have certain markets that are just not leasing, but we see a lot of health in even in very unremarkable markets that, among other things, are probably undersupplied because they're so unremarkable. We feel that it's worth being courageous in acquiring office, and that's what we're doing.
Thanks. I think from a lending standpoint, we sort of echo all the same sentiments, especially around multifamily and industrial. I think when we look through our book, the last few multi and industrial deals and industrial adjacent have all sort of been this kind of where we think positive supply-demand economics are coming in, where we can actually get into whether it's development of assets or assets that need some stabilization, and we think that there's a lot of runway on the leasing front. I think the one thing that maybe folks, I know Francis said he stays away from, and I'm not sure, Maggie, if you're playing there, is hospitality. We recently did a couple where kind of a similar trend to what you're saying on the student housing, where we tried to stay away from assets that require a lot of international travel, assets that require a lot of ultra high-end kind of discretionary spending, so focus on a lot of drive-to destinations and kind of where the attractions are a little bit more cyclical. Maybe shifting gears slightly, we've seen an increase in mezzanine, preferred equity, kind of hybrid capital structures. Have you guys started looking into those? Have you seen the trade-offs? Are you kind of pushing back on some of that? How has that kind of dipped into your borrowing, and how has that impacted the strategy going forward?
Sure, I can go first. I mean, in multifamily, I feel like it's the flavor of the day for the 2021, 2022 vintage product. It's the way you're going to, stay alive and let your NOI ramp. But it's gap capital. It's not something you want to do. You kind of have to do it. Otherwise, you have to cut your losses and go. So, that capital comes in at 13, 14%. What's interesting is that our investors look at that capital and they're like, wait, we want that return. So, it's in a couple of processes recently where we went out to finance, we would get the stretch senior, but then that actual little mezz pref piece would be one of our investors stepping up and taking it. So, I think investors are getting smarter and more creative as we live to fight another day in the multifamily space. But yeah, it's definitely part of our everyday financing strategy.
Well, we're the opposite. as I told you, my religion is positive leverage, and I don't know how you could buy a multifamily property at 7 and pay 13 or 14%. I mean, basically, it means that you're buying at very negative leverage, and really means your equity's getting no current return, if barely that. So, when that serving dish comes my way, I just say no, thank you, and we stick to more traditional, more patient, and because you can only pay 13 or 14 for so long, and then sooner or later, you're going to have to sell the asset. And we tend to be very long-term owners. I mean, we sell things opportunistically, but we don't like to have to be forced to sell something. One area that I forgot that I didn't mention is international investment, which is an area that we're active in, and we're right now thinking very positively towards Europe. I mean, we have a significant European portfolio in a number of countries: Germany, England, actually all of Great Britain, large portfolio in Holland, places like that. And we just think that these days, being diversified, not only in terms of product type and markets, but internationally, might become more and more a strategy that's appealing to investors who want to have that kind of diversity in their portfolio, in addition to all the other types. So we're doubling down on our European operations.
Great, thanks. I think at this point we're fine to open it up to Q&A if there's anything from the audience that folks wanted to mention or bring up for myself or any of the panelists. For you, Mr. Greenburger, Leo Jacobs.
Yeah, sure.
Hi. Good morning to everybody still. Mr. Greenburger, you mentioned about DSCR, and you say that you won't accept I guess, a loan or a covenant that deals with technical defaults with debt to service coverage ratio issues. Have you had any control in taking those covenants out or modifying them at the very least? Because in our industry, the legal industry, it's almost a take it or leave it. It's almost standard. But I want to know if leverage has anything to do with it at all. For you. Thank you.
Okay. Well, thanks for that question, because we do have an approach, which I'm happy to share with you, because I think the more of us who ask for it, the more of us will get it. So what I say is that resizing makes no sense. What we will do is where there's a DSCR, where it falls below whatever the DSCR threshold that we agreed to, whether it's 120 or 130 or maybe multifamily 110 or whatever it is, that we will put up an escrow equal to a year of the gap. A year of the gap. So if the if the DSCR falls to 100 and the threshold is 130, then we will put up a year's worth of interest for that 30-point gap. So in theory, the lender gets comfort from that and knows that our plan is to keep going with the property. Of course, we're still paying them currently, so there's no default of any kind. And we have had, I would say, widespread acceptance of that approach with both CMBS lenders as well as balance sheet lenders.
Thank you.
You're welcome.
Anywhere else?
If I don't do well in the real estate business, maybe I can get a job in your law firm.
I think there was one over here.
Maggie, I'm just curious on the multifamily ground up, sort of, A, what is your plan in terms of, are you long-term holders, are you merchant builders? And B, generally, what are you underwriting to in terms of return on cost, and what are you assuming for exit cap rates?
All great questions. We're all asking ourselves that. Our primary bucket of capital is a $250 million closed-end fund, Fund 7. So we have a short amount of time to make our return. So these sites may not be part of this fund, and then we'll roll them in once we get the entitlements and the capitalization. But as far as returns go, they're creeping down. Return on cost, it's not unusual to have a 5 handle, which, yeah, it's on the cusp.
I appreciate your honesty.
Yeah, it is what it is. And the exit cap rates are in the mid-4s. And we're seeing trades today in the mid-4s. But I won't beat around the bush. It's cuspy right now. Not in Iowa, but major markets. We're up and down the coast on California.
Yeah, I actually think we recently closed on a ground-up multifamily construction in LA, high-end, ultra-luxury, and I think we had the fortunate ability, given that we're in the debt, to underwrite slightly higher cap rates and still feel comfortable about our basis and the takeout, but I think our sponsor was exactly in the range where you were.
Oh, and you were asking about the whole return on the project. It's usually in the low to mid-20s.
I think we have one more over here.
Thanks. You mentioned you were bullish on Europe and UK things in particular. Could you go into a bit more details as to why? You might notice
Why?
from the accent that I have a vested interest.
Yeah. Your question was why? Well, I can give you a macro investment strategy, or which has a political handle on it. I think in this world of complex political currents, it's good to be diversified and not be overly dependent on one governmental environment as opposed to another. So I just think, if you're operating a diversified portfolio, it's good to be tied to a variety of governmental approaches as opposed to just one. Specifically, if we want to talk about England or Great Britain, Great Britain, as I'm sure you know from your accent, I assume you're English, that Great Britain is, for whatever reason, is sort of a little bit under-lent. The lending environment there, interest rates are higher than in Europe. And that's a sort of interesting disconnect. And as a result, cap rates on selected deals, but are expanded or are not compressed. So we find that interesting, and whether or not interest rates ever come down on par with Europe, that's a factor. But since we're buying it at cap rates which reflect the current elevated British rates, we think that those are good fundamentals, and we're just buying we just bought 2 months ago a very nice building in downtown Glasgow, Scotland, and there was one floor that wasn't leased, but leased up that floor, which we've done in the short time that we've had it, and we had a tenant in tow. I think we bought close to a double-digit cap rate, and a good per pound price. So we think that there are good opportunities in the UK, and we're pursuing them. We have 2 other deals right now going on in the UK as well, which we haven't closed on yet. So we think it has interesting characteristics. If you have other information, please give it to me.
For one final question.
Thank you. With your interest in Europe, is it a comfort level, or have you looked at emerging markets, other than Japan, of course, with their ghost cities, but the those parts of the region of the world, they're prospering and they have a high demographic, and just overall they're prospering.
Well, as you could tell from some of my remarks, I'm always very concerned about sovereign risk, regardless of where it exists. And as we know, there are no exemptions, if you get my drift. Anyway, so when it comes to more adventurous emerging markets, I would say that I'm more conservative than some. I was talking with a colleague before, and we were talking about Sam Zell, and in Sam's day, he went all over. He went to Brazil. Depending on what day you talked to Sam, he would have told you he did okay, or he told you he had a major headache. I think he had a major headache. He was active in South America. He would go. I have not invested in South America so far. I might go to Uruguay on a good day. I do have not a more personal investment, but I do have an investment in the Caribbean. But other than that, I've stayed to Europe. I am interested in Asia generally, but China, I wouldn't put any of my hard-earned money there because it's very, very hard to get back. You might do fine in Chinese currency, but don't try to take it home with you, etc. But looking at sovereign risk is an integral part of being an informed international investor.
All right. Well, that's a serious amount of intellectual capital on this stage, so thank you all for your thoughts. Let's give it up for the panel.